Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Dr. Copper just delivered a historic verdict on the global economy, and traders need to understand what this signal means. On January 29, 2026, the three-month copper contract on the London Metal Exchange hit an all-time high of $14,527.50 per metric ton. This represented the largest single-day gain in over 15 years. For the month, copper delivered 9 to 10% gains, capping a six-month winning streak that produced cumulative gains of 36%. We're now in late February, roughly 4 weeks past that peak. And the question every trader is asking, is this the beginning of a structural supercycle or a speculative blow-off top? Let's establish context. Copper earned the nickname Dr. Copper because of its uncanny ability to diagnose economic health before other indicators. This metal touches every corner of industrial activity, from construction to electronics to transportation. When copper roars, it's typically signaling major economic shifts ahead. According to Benchmark Minerals, the January surge delivered price action we haven't witnessed in over a decade. This wasn't a gradual climb. This was explosive, urgent buying that pushed copper through resistance levels and into uncharted territory. 4 historical episodes provide the roadmap for understanding what comes next. First, the 1970s oil crisis era. During the oil price shocks of that decade, copper prices surged between 56 and 90% during peak oil price periods. These moves reflected supply chain chaos and inflation hedging as the monetary system fractured. Second, the China supercycle from 2004 to 2008. This was the big one. In May 2006, copper reached a then-record $4.08 per pound in what traders called a blow-off top. China's infrastructure boom consumed copper at unprecedented rates, creating the template for commodity supercycles. Third, the post-financial crisis recovery from 2009 to 2011. Copper staged a spectacular recovery with gains exceeding 250%. Global monetary stimulus and infrastructure spending programs drove that rally. Fourth, the COVID recovery from 2020 to 2021. Copper surged over 80% as supply chains seized up and economies reopened with massive fiscal support. Each episode shared common DNA: supply constraints, monetary policy shifts, and structural economic changes. The January 2026 surge combines elements from all 4 precedents, which makes it particularly significant. Now let's break down the drivers behind this move. Start with supply. The physical copper market is genuinely tight. Mine accidents, flooding, and seismic activity have disrupted production at key facilities globally. According to Astraca's Global Copper Market Analysis for January 2026, inventories have hit historically low levels. This isn't speculative positioning creating artificial scarcity. This is real metal not making it to market. But here's where it gets interesting. The demand side has a new player that didn't exist in previous cycles: artificial intelligence infrastructure. According to research from Sprott, copper consumption from AI infrastructure and data centers is projected to explode from 110,000 tons in 2025 to 475,000 tons in 2026. That's a 332% increase in a single year. This is an entirely new category of industrial demand, and it's massive. Steve Schofstall from Sprott emphasizes that structural supply constraints, combined with escalating demand from electrification and AI, could sustain copper's upward trajectory for years. The bullish case rests on several pillars. First, genuine supply constraints that will take years to resolve. Second, structural demand growth from multiple sectors hitting simultaneously. Third, chronic underinvestment in new copper mining capacity over the past decade. Fourth, the energy transition's copper intensity being significantly higher than previous industrial cycles. Beyond AI, the broader electrification trend continues accelerating. Electric vehicles, renewable energy installations, and grid modernization projects all require substantial copper inputs. This structural demand shift provides a long-term floor beneath copper prices that previous cycles lacked. Geopolitical tensions have added a risk premium to prices. Chinese investors have notably increased their speculative positioning, adding a financial demand layer that amplifies underlying physical market dynamics. Fastmarkets revised their 2026 copper price forecast to an average of $10,943 per ton, while acknowledging that bullish scenarios could drive temporary moves near $15,000 per ton. That's the consensus bull case from the analyst community. But let's examine the bear case, because it matters. Reuters reported in early February that some analysts are warning fundamentals do not support copper at current levels. The characterization from some market commentators is that we're witnessing a debasement trade, where investors flee traditional safe havens for hard assets amid concerns about government deficits and monetary policy. According to Yahoo Finance, some analysts describe the current rally as unsustainable, suggesting speculative excess that could prove vulnerable to sharp corrections. The speed and magnitude of the move raises red flags. 9 to 10% monthly gains followed by that explosive single-day surge on January 29th looks more like panic buying than orderly accumulation. The critical distinction for traders is whether this represents sustainable structural demand or speculative froth. The convergence of AI infrastructure needs, electrification trends, and supply constraints creates a compelling fundamental case. However, that explosive price action suggests speculative elements that could unwind quickly. Let's talk timeline for supply response. New mine development typically requires 7 to 10 years from discovery to production. Near-term supply relief depends primarily on existing capacity expansion and recycling improvements. That means if demand stays elevated, prices could remain structurally higher for years before meaningful new supply hits the market. On the demand side, while AI and electrification appear structural, the pace matters. AI infrastructure copper consumption growing 332% year over year is extraordinary. But can that pace sustain? Initial infrastructure build-outs create demand spikes that moderate once base capacity is established. Copper remains highly sensitive to global economic conditions. Any significant slowdown in economic growth, changes in monetary policy, or resolution of current geopolitical tensions could quickly alter the supply-demand balance. That's the macro risk sitting beneath this rally. For traders, the positioning question is critical. Mining equities have leveraged exposure to copper prices. Companies with significant copper production saw substantial equity appreciation through January. But that $14,527 peak on January 29th hasn't held. We're now 4 weeks past that high, and prices have moderated, though they remain elevated historically. The implications extend beyond commodity markets. Higher copper prices translate into increased costs for infrastructure projects, renewable energy installations, and electric vehicle adoption. Ironically, elevated copper prices could slow the very energy transition driving copper demand. That's a self-limiting mechanism worth monitoring. For portfolio positioning, copper offers exposure to multiple structural themes: artificial intelligence infrastructure build-out, electrification and energy transition, and potential inflation hedging. But the entry point matters enormously. Chasing parabolic moves near all-time highs carries obvious risks. The options market and volatility indicators around copper futures will provide real-time signals about whether this consolidation phase represents healthy digestion before another leg higher or distribution ahead of a deeper correction. History suggests copper moves of this magnitude typically precede significant economic transitions. The 1970s copper surge preceded a decade of inflation and economic restructuring. The China supercycle copper peak preceded the financial crisis. The post-COVID copper rally preceded the inflation surge of 2021 and 2022. Copper's diagnosis appears clear. We're living through profound structural economic change. The question is whether that change proves durable or gives way to correction through demand destruction and supply response. The next few months are critical. If copper can hold above $12,000 per ton and build a base for another move higher, the structural bull case strengthens. If we see a breakdown below $10,000 per ton, the speculative excess narrative gains credibility and the trade becomes significantly more dangerous. Watch London Metal Exchange inventory levels, Chinese economic data, and AI infrastructure investment announcements. Those data points will provide the clearest signals about whether January's surge marked the beginning of a multi-year supercycle or a speculative peak. Bottom line for traders, copper delivered one of the most dramatic moves in modern commodity history in January 2026. The $14,527 all-time high on January 29th represents a confluence of genuine supply constraints, revolutionary demand sources from AI infrastructure, and speculative enthusiasm. Whether this proves sustainable or corrects sharply will likely determine not just copper's future trajectory, but signal broader economic direction for 2026 and beyond. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.